Probably the worst situation you can find yourself in is when you have to depend on others to support you in your retirement years. That is why learning how to invest is so important. For many people, it could make the difference between a blissful retirement and a painful one. The investment environment has become very diverse in the last decade. To succeed at investing, you need to keep abreast of what is happening in the investment markets. Once you're armed with a basic knowledge of investing, knowing what is happening in the markets will become not only less strenuous, but also an enjoyable pastime. And most importantly, investing is your responsibility, not anyone else's. It is neither the government's responsibility nor that of your personal financial specialist. Investing in index fund. So, what's an index? Basically, it is a list of investments. An index fund can give you exposure to many stocks in a single investment without the high fees of actively managed funds. An index fund is a mutual fund or ETF whose portfolio is designed to replicate a certain market index of stocks, bonds, or another type of investment. For example, the popular Dow Jones Industrial Average, or simply the Dow, is an index that consists of 30 large U.S. stocks weighted by share price. So, an index fund that tracks the Dow would be expected to own all 30 stocks in approximately the same proportions that they make up in the index. Let's use S&P 500 as an example. The S&P 500 is a roster of the 500 largest U.S. companies with publicly traded shares. The S&P market cap is 70 to 80% of the total U.S. stock market capitalization. It is a commonly used benchmark for stock portfolio performance in America and abroad. Beating the performance of the S&P with less risk is the goal of nearly every portfolio manager, hedge fund, and private investor. Each stock's weight on the list is usually determined by its overall market value. For example, let's say online retail giant Amazon.com Inc. accounted for about 3% of the S&P 500, whereas Chipotle Mexican Grill was less than 0.05%. Likewise, an S&P 500 index fund would hold 3% in Amazon and 0.05% in Chipotle. In the simplest sense, an index fund is an investment fund that attempts to replicate the performance of a given index of stocks or some other investment type. That can include bonds or even a narrow subset of a financial market, say small cap biotech companies. First, because index funds don't require much effort from managers, they typically have lower fees than actively managed funds. It's not uncommon to find index funds with expense ratios in the 0.05% to 0.07% range, while actively managed funds are generally in the 1 to 2% ballpark. Additionally, index funds allow investors to harness the long-term potential of the stock market without the guesswork and research involved with choosing individual stocks. It sounds like a good way to diversify, and it is, but there are some disadvantages to using index funds. For instance, if you buy a typical index fund through a brokerage, you can't expect a stiff commission. Of course, you could buy index funds managed by your own brokerage, and as a result, avoid the commission. Like mutual funds, index funds are traded in units and settle at the end of the day. Index funds generally tend to be less volatile than most individual stocks, but they're only as stable as the underlying index. In other words, you want to look at the index fund's holdings to keep your money in the right places. Research whether the ETF holds actual stocks or if it's a synthetic fund that tracks the underlying index with derivatives but doesn't actually own any of the shares. Unless you've been living under a rock, you probably have heard about derivatives. I will go over the basic derivatives later in the presentation. Also, don't invest in an index fund unless you can sit it out for at least 5 years. 10 is even better. If that criteria is met, an index fund can be an excellent vehicle for investing in the market. Investing in exchange-traded funds, or ETF. An ETF trades like a stock on an exchange, so its price fluctuates during trading hours. By owning an ETF, you get the diversification of an index as well as the flexibility of trading it like a stock. You can sell short, buy on margin, and purchase as few as one share at a time. Your upfront cost of buying an ETF is the brokerage fee, which is the same as that paid for stock trading. And there is no 3 to 5% front-end load, which is typical for a mutual fund. In fact, they are not all that different from regular mutual funds, meaning that instead of having managers specially choose which investments to hold, they passively mimic some list of investments. Also, like mutual funds, they pool together investors' money to buy a diversified portfolio of stocks or bonds. The only difference is that instead of buying an ETF directly from a fund company, you buy a share of it through a brokerage, just like you would a stock. Because of this, you may lose some of that price advantage to trading costs. Since you have to buy ETFs via a broker instead of direct from the fund company, you could pay a commission each time you buy or sell ETF shares. However, ETFs have lower expense ratios. Its passive nature means the fund manager has to do far less research and analysis to construct the ETF. Most ETFs fully replicate the underlying index by investing in every stock in the index, weighted proportionately. It is because of this passive approach to mimicking the index that ETFs are never expected to beat or lose out to the underlying index in terms of performance. Investing in hedge funds. Hedge funds continue to offer investors a solid alternative to traditional investment funds, an alternative that brings the possibility of higher returns that are uncorrelated to the stock and bond markets. A hedge fund is an alternative investment vehicle available only to sophisticated investors such as institutions and individuals with significant assets. Like mutual funds, hedge funds are pools of underlying securities. Also, like mutual funds, they can invest in many types of securities. First, hedge funds are not currently regulated by the U.S. Securities and Exchange Commission, SEC, a financial industry oversight entity, as mutual funds are. Second, as a result of being relatively unregulated, hedge funds can invest in a wider range of securities than mutual funds can. Hedge funds typically use long-short strategies, which invest in some balance of long positions, which means buying stocks with the expectation that the stocks will rise in value, and short positions, which means selling stocks with borrowed money, then buying them back later when their price has ideally fallen. Additionally, many hedge funds invest in derivatives, which are contracts to buy or sell another security at a specified price. You may have heard of futures and options. These are considered derivatives. Third, hedge funds are typically not as liquid as mutual funds, meaning it is more difficult to sell your shares. Mutual funds have a per-share price called a net asset value that is calculated each day, so you could sell your shares at any time. Most hedge funds, in contrast, seek to generate returns over a specific period of time called a lockup period, during which investors cannot sell their shares. Mutual fund managers are paid fees regardless of their fund's performance. Hedge fund managers, on the other hand, receive a percentage of the returns they earn for investors, in addition to earning a management fee, typically in the range of 1 to 4% of the net asset value of the fund. that is appealing to investors who are frustrated when they have to pay fees to a poorly performing mutual fund manager. As a result of these factors, hedge funds are typically open only to a limited range of investors. Specifically, U.S. laws require that hedge fund investors be accredited, which means they must earn a minimum annual income, have a net worth of more than $1 million, and possess significant investment knowledge. In the United States, accredited investors must meet one of the following standards: personal income of at least $200,000 each year for the last 2 years, or $300,000 combined income if married, and have the expectation to make the same amount current year. Personal net worth of $1 million or more, either individually or with a spouse, excluding your primary residence. A charitable organization, corporation, or partnership with assets exceeding $5 million. Business in which all the equity owners are accredited investors. A director, executive officer, or general partner of the company selling these securities. Sophisticated investors have both the knowledge and experience necessary to evaluate and understand the risk and merits of an investment. When considering if a fund is a hedge fund, you should look at whether it has non-traditional investment strategies such as leverage. That refers to the degree to which the fund is using borrowed money to invest. For example, if the fund is leveraged 100%, it means it has borrowed $1 for every dollar that it actually has. Short selling, a short strategy of sell high, buy low, which means selling stocks with borrowed money, then buying them back later when their price has fallen, rather than buy low, sell high, which is called a long strategy. And arbitrage. Arbitrage is the simultaneous purchase and sale of an asset to profit from an imbalance in the price. It is a trade that profits by exploiting the price differences of identical or similar financial instruments on different markets. Or investments are in a non-mainstream asset classes, that is, investments other than listed equities, bonds, and cash. Investing in hedge funds can be risky and should seek a knowledgeable financial advisor or a personal financial specialist to give you advice. If you want to invest in a hedge fund for retirement, look for lesser risk funds and capital guaranteed funds. Also, hedge funds should comprise no more than 20% of your overall portfolio. Investing in derivatives. Derivatives are widely used today. It's all about risk and return. Derivatives can help stabilize the economy or bring the economic system to its knees. Most derivatives are based on the person or institution that is, on the other side of the trade, being able to live up to the deal that was struck. A more complex type of investment, derivatives offer countless opportunities for making money, if you're willing to take the risk. A derivative is a contract between two parties whose value is based upon or derived from a specified underlying asset or stream of cash flows. Options, swaps, and futures are commonly traded derivatives, whose values are impacted by the performance of underlying assets. An oil futures contract, for instance, is a derivative because its value is based on the market value of oil, the underlying commodity. While some derivatives are traded on major exchanges and are subject to regulation by the Securities and Exchange Commission, SEC, others are traded over the counter or privately. With a derivative investment, the investor does not own the underlying asset, but rather is betting on whether its value will go up or down. Derivatives usually serve one of three purposes for investors: hedging, leveraging, or speculating. Hedging is a strategy that involves using certain investments to offset the risk of other investments. If you own a certain stock and are worried about its price falling, you might buy a put option, a type of derivative that gives you the ability to sell that stock at a certain price at a specific time. This way, if the price falls, you're somewhat protected because you have the option to sell it. Leveraging is a strategy for amplifying gains by taking on debt to acquire more assets. If you own options whose underlying assets increase in value, your gains could outweigh the cost of borrowing to make the investment. Speculating is a strategy that involves betting on the future price of an underlying asset. You can use options which give you the right to buy or sell assets at predetermined prices to make money when such assets go up or down in value. Common types of derivatives. Options. Options are contracts that give the holder the right, though not the obligation, to buy or sell an underlying asset at a preset price on or prior to a specified date. A put option gives the holder the right to sell an asset at a predetermined price and is comparable to having a short position on a stock. If you buy a put option, you'll want the price of the underlying assets to fall before the option expires. A call option, meanwhile, gives the holder the right to buy an asset at a preset price. A call option is comparable to having a long position on a stock. And if you hold a call option, you'll hope that the price of the underlying asset increases before the option expires. Employee stock options. Granted as part of the compensation for working for a company, employee stock options are a type of derivative that allows the employee to buy the stock at a specified price before a certain deadline. The hope of the employee is that the stock increases in value substantially before the derivative expires, so he or she can exercise the option and sell the stock on the open market at a higher price, pocketing the difference as a bonus. Futures. Futures contracts are agreements between two parties where they agree to buy or sell certain assets at a predetermined time in the future. Futures are predominantly used in the commodities market. Airlines often use futures to hedge their jet fuel costs. It's an agreement traded on an organized exchange to buy or sell assets at a fixed price, but to be delivered and paid for later. Swaps. Swaps are contracts in which two parties agree to exchange cash flows. This exchange takes place at a predetermined time as specified in the contract. Banks, financial institutions, and other organizations normally enter into derivative contracts, known as interest rate swaps or currency swaps. Typically, at the time a swap contract is initiated, at least one set of cash flow is based on a variable, such as interest rate or foreign exchange rate fluctuations. Swaps are not exchange-oriented and are traded over the counter. Usually the dealings are oriented through banks. The best investing strategies are not always the ones that have the greatest historical returns. The best strategies are those that work best for the individual investor's objectives and risk tolerance. The best strategy is the one that works best for you. I hope this presentation gave you some basic understanding of different investment vehicles available for your personal needs. I'll be going over other types of investment choices later. If you like this video, please subscribe and give me a thumbs up.